As earnings season comes to a close, this is part 3 of To Buy or Not to Buy. I covered the state of the U.S. economy in the first part, so check that out for some commentary there. I want to dive right into the buy prices in this video, so cue the intro. Welcome to The Quality Investor. Today, we are looking at 4 more businesses and what their buy price is, with a margin of safety, of course. Each of these businesses had strong quarters. The more capital-intensive businesses are investing in CapEx spend for the future, and a case can be made for strong future free cash flow growth for each. So, without further ado, we are going to review the buy prices of the following businesses: Amazon, Cadence Design, Fortinet, and Meta. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Here are the 4 stocks that we are looking at today: Amazon, Meta, Cadence Design Systems, and Fortinet. We have their market cap, price, buy price, the difference to get to that buy price, and the implied free cash flow growth given their current price in the market. Starting with Fortinet. They have a market cap of $78 billion, and their current market price is $102.02. My buy price for Fortinet is at $95. Now, to get to that $102 market price, the market is pricing in free cash flow growth over the next 10 years of 10.4%. My base case free cash flow growth for Fortinet sits at 13.09%. So the reason I have them at a buy price of $95 is more or less due to the margin of safety, which I use a 20% margin of safety. Without a margin of safety, I price Fortinet at about $116 a share. Fortinet would need to come down in price by about 7% to make me comfortable buying into it again. I would love to buy more Fortinet stock. I think it's one of the best businesses that I currently own. And one of the reasons is they have an incredibly strong economic moat. Their FortiOS platform seamlessly ties together their firewalls, their SD-WAN, their unified SASE, and their security operations. This creates the high barriers to entry that any business would love to have and drives high margins. The reason for the high barrier to entry is the capital-intensive nature to recreate this ecosystem. On top of that, when a business adopts Fortinet products, there are very high switching costs. Simply dropping Fortinet and transferring your entire cybersecurity operation to another business is counterproductive. In Q1, their service segment, which is the highest revenue segment of their business, had $1.08 billion in revenue, but that was fueled by subscription growth of 16%. Fortinet has a trailing 12 revenue of $6.1 billion, but a backlog of $6.5 billion. So we should continue to expect strong growth for Fortinet in the years to come. Fortinet is a very strong business with a very bright future. They're a little bit too rich for me right now, but they are a volatile business. So it's very likely that they'll come down below $95 again, at which point it'll be a great time to pick up some more shares. Meta seems to be a very polarizing business. People either love or hate Zuckerberg, but over time has proved itself as a very reliable cash generation business. It's a massive market cap at $1.7 trillion and a current price in the market of $694.14. My buy price, however, for Meta is at $550. It is actually brought down a bit by a 20% margin of safety, along with a very low dividend discount valuation, as well as exit multiple comps that are less than favorable. This gives us a 20.77% difference. That would be quite a drawdown for the stock, although it's happened before. And the market is currently pricing in free cash flow growth for Meta at 8.76%. My own free cash flow growth on a baseline for the next 10 years for Meta is at 13.1%, which puts their buy price without any margin of safety right in line with the current share price at $686.29. Meta's revenue is completely driven by ad performance. However, they're trying to bolster that growth using AI. They have nearly 1 billion monthly active users for Meta AI, and they say that their AI-driven ad tools are boosting conversion rates by 5%, and 30% more advertisers are leveraging Meta's AI tools. They had strong operating margin expansion year over year in their most recent earnings at 350 basis points, and a strong track record of reinvestment back into the business, which is indicated by a 29% return on invested capital. And that's important to note because they have a massive CapEx spend. Their 2025 outlook is at 64 to 72 billion in capital expenditures, which is to fuel AI infrastructure. Meta is all in on AI. Mark Zuckerberg highlighted 5 growth pillars, 3 of which are focused on AI. They have AI advertising, engaging content, business messaging, Meta AI, and AI devices. And with a strong network effect, which provides a wide moat for Meta, we should see strong, sustained growth over the next 10 years. In my view, Amazon has the best growth potential of all the businesses on this list. And that's already with a market cap of $2.26 billion. They have a current price in the market of $213.20. My buy price is at $210. So they just recently became slightly too rich for my tastes. They would have to fall about 1.5% for me to want to purchase more shares. The market is pricing in free cash flow growth over the next 10 years of 16.85%. My own base case for Amazon has free cash flow growth at 22.3%. And this is mostly driven by AWS, which is an incredibly high margin business, expanding its margins to 39.5% in Q1 of 2025. AWS growth is slowing a little bit, but it's still very high at 17%. And their advertising segment saw 19% year over year in Q1, which is another high margin business. Depending on the source, it is estimated that Amazon's advertising business operates at a 50% margin. And even at $213.20 in the market, Amazon is down about 13.4% year to date, as they have been casualties of the ongoing tariff debate in the US economy. I mentioned that in my view, Amazon has the best growth potential though, and the reason is how economically diverse the business is. Everyone knows they dominate online retail, but they have a logistics business that is larger than both FedEx and UPS. They have the largest cloud platform and have a built-in advertising business that is coming for Meta and Google. And they're also investing heavily into the future. They have a CapEx spend of Q1 of $24.3 billion and are expected to spend over $100 billion in CapEx in 2025. Amazon is certainly not shy about dropping massive expenditures in their future, and they have a track record of it paying off. So I'm quite excited for Amazon's future growth. This is another business that has a lot of volatility. So coming back down below $210 probably will happen sooner than later, and would be a very good time to scoop up more shares. Cadence Design Systems is a business I've had my eye on for a while. They are a leading provider of electronic design automation software, which is critical to designing cutting-edge semiconductor technology. All of these advanced AI chips that we see these days all had to be designed initially, and Cadence provides the software to do that. And because of this, Cadence has traditionally traded at a high premium. Their current price in the market is $307.20. My buy price is $280. So they would have to come down about 8.9% for me to be comfortable buying into them. The market is implying a free cash flow growth for Cadence at 19.5%. My own baseline free cash flow growth for Cadence is at 18.3%. And without any margin of safety, my buy price for Cadence is right in line with the current market price at $311, but I am using a 10% margin of safety to get to that $280 buy price. That would give us a forward PE of 66.5. Their current forward PE is at 73. So a PE in the 70s definitely indicates that this is a premium business, and with good reason. They have a massive economic moat driven by intangible assets, actually, because they possess valuable intellectual property. Their EDA software is proprietary and is optimized for advanced manufacturing processes of the latest cutting-edge semiconductors. This makes it difficult for competitors to replicate their IP. And on top of that, similar to how Visa and MasterCard dominate the credit card market and create a duopoly, Cadence operates in the EDA industry as a duopoly with Synopsys. Together, these two businesses control roughly 74% of the EDA market. Cadence has a market share of about 36%, Synopsys at 38%, and this creates high barriers to entry. And given where the industry is going with AI chips, there's secular tailwinds, and Cadence will be the beneficiary of that. Even more complex designs are required to power our AI future. So this is the last part of my 3-part series of to buy or not to buy. And the 4 businesses we looked at today are all slightly on the rich side for me, but given some recent market volatility, it's highly likely that they'll come back down into buy territory, at which point I think it would be good to scoop up some shares of each of these very strong, high free cash flow businesses, in which not only myself, but the market is implying strong free cash flow growth over the next 10 years, as each of these are in businesses that are either driven by or driving AI, which is shaping up to be the next great revolution in the US economy. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.